Today, I'd like to introduce you to what we refer to as Registered Disability Savings Plan, or RDSP. Okay, so the purpose of an RDSP basically is savings for a disabled child. Now, that child could be mentally or physically disabled, but the point is that they are disabled and therefore unable to take care of their own affairs. So as long as you're alive, obviously, you can take care of them and everything else. But what happens if you died? Okay, like who's going to take care of them? They have no means to take care of their own affairs. They have no means to take care of money and all this. So even if you turned around and your life insurance policy and you left your disabled child as a beneficiary, that child may be mentally or physically disabled to the point where they're not really able to take care of all that money anyways. So next thing you know, you've got nobody managing that money. So what provision could you have? What kind of a policy could you have to make sure that that child will be well taken care of should anything happen to you at all? Well, one of the things you could do, okay, obviously, is buy an RDSP. I mean, there's other options as well, but one of the options is an RDSP. So in order for that child to actually qualify to buy an RDSP, basically, you're buying it on behalf of that child. So the eligibility basically is that the child must be disabled. Okay, the disability they have to get what's called a disability tax credit. Ottawa has a disability tax credit. So when you do your filing, you can indicate on there that your child is disabled, and therefore they will give you a tax credit. So if they have a disability tax credit, then basically that's one way of making sure that you qualify for an RDSP. That child also must be a Canadian resident. So this is not something you can do for a child that may be living overseas or anything. They have to be a Canadian resident because they have to file. Remember, they have to file for that disability tax credit, so they obviously can't file if they're outside the country. Also, they have to be under age 60. Okay, so the RDSP basically income starts at age 60, so obviously they have to be, can't be any older than age 60. And they have to apply for the RDSP by no later than age 59. So obviously at age 59, you're not going to have much time for growth or anything because the income has to start at age 60. So we obviously recommend that you do it well in advance. But basically, the last time that you can make any contribution to an RDSP is in fact age 59, because at age 60 an income starts. Okay. Also, that individual must have a social insurance number, so they have to show that they are, in fact, a legitimate Canadian resident and a taxpayer and so on. So you have to have a social insurance number as well. The contributions that are made on behalf of that child, they're not tax deductible. So it's not like an RSP where you have a deduction here or anything. They are, you make those contributions and everything. However, the money that's sitting in the plan is tax deferred, just like an RSP. So it is a deferral of taxes. So you don't have to worry about having to pay taxes every single year. The only thing is that the actual money that you're putting into the plan is not deductible, but the accumulation period and everything else up to age 59 and subsequent to that, that's not going to be taxed. The only time you're going to have to pay taxes once again is when you actually make those withdrawals. Starting at 60, and of course you have to start to pay your taxes at that time. The lifetime limit is $200,000. There's no monthly lifetime or annual lifetime income. Okay, limit basically for that child on a monthly basis or annual basis or whatever. But the total cannot be any more than $200,000. So if you want, you could in fact start one of these and put the entire $200,000 in one shot, basically, and that's it. Or you can simply take that and pay it over a period of time. But the total contribution cannot exceed the $200,000. That's what they refer to as a lifetime maximum. And as I said, there's no annual limit. You can put whatever it is, $10,000, $20,000, $30,000 a year. That's not it. But as long as you don't exceed that $200,000. So where's this money going to come from? Okay, where does all this money come from? So the contribution could come from all sorts of different places. Obviously, your regular income that you have from your salaries, whatever it is. Obviously, that can be done. Inheritance. The child could have grandparents, for example, and the grandparents leave the child $100,000, let's say, in inheritance and everything else. So all that money, as long as, again, you don't exceed that, all that money can go into RDSP as well. Life insurance. As I said earlier, you're leaving a life insurance policy to a child. That child may not be in a position to handle that money, manage the money, whatever it is. So how do you protect yourself against that kind of thing? There, you can actually leave the RDSP as a beneficiary, so your life insurance policy gets paid into that. Also a rollover. Okay, you have RSP money. You're dead. You can roll that over to your RDSP. Your RIF, so you're over 71, let's say, now you have a RIF, whatever's left over, you're dead, that can be rolled over in RDSP as well. On RPP, same thing, okay, it's your registered pension plan. If there is a death benefit in your registered pension plan, then whatever monies are left over, once again, can be rolled over to an RDSP. So the key word here is rollover. So as long as you're rolling over, there's no deemed disposition, so therefore there'll be no taxation on the rollover. The taxation will occur, of course, once the money actually starts coming out month by month or year by year. You will have to, so on withdrawal, yes, you will have to pay tax, okay? But the money moving from your estate, let's say because you're dead, from your estate over to the RDSP, there will be no deemed disposition here. Strictly be a rollover provision, and therefore you avoid any kind of taxation. So once again, it's avoiding the tax immediately, but you are deferring it to a future date. So at some point, you will have to be paid, but you'll be way down the line. There's a couple of more things that I want to show you in a